All right. Hi, everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have once again on my podcast Stuart Kruse. So, welcome back, Stuart.
Thanks, Richard. Great to be back.
Nice. So, today we're going to talk about 2024, the stock market. It's going to be a year in review. So, see what happened throughout the year and what's ahead for 2025. So what's your well, Stuart, tell everybody a little bit about who is Stuart Kruse, and then we'll start after.
Yeah, okay, that's fair. So I founded Kruse Asset Management in 2007. It was a financial advisory firm that the main goal was to try to bring institutional level products and services to the retail client, because there's a little bit of a disconnect and an advantage on the institutional side over the retail space. So I started with math first. We wanted to really bring math and quantitative solutions to the retail client. So everything we do is quantitative in nature. So talk about numbers, statistics, math all the time. Since then, we've opened up the space to create a virtual family office. And family office concept was created by the Rockefellers initially. It's a family with so much money that they needed to have a team of financial professionals working together on the behalf. Right now, the model is that the client sits in the middle of all his advisors. So the client talks to the wealth advisor, talks to the CPA, the client talks to the estate planning attorney, the insurance guy, and they try to make these independent decisions. But wouldn't it be better if they were all working together? So that's what we try to do. We try to have all of those pieces working together, speaking financial language amongst themselves, coming to an optimal solution, incorporating each other's concerns and options and theories, and then presenting that to the client as if the client has their own family office right now. So that's what Kruse Asset Management does.
All right. So the year is coming to an end. So what's your outtake on 2024?
Well, obviously, the headlines are, it was a great year in the stock market, and that was true, right? So year to date, right now, the S&P's up 30%, call it. So by any measure, that's a fantastic year. That said, the Magnificent Seven, the NVIDIA's, Google's, Facebook, those top 7 names, they comprise over 35% of the market itself. So they're responsible for 1/3 of all the stock market moves right now because of how big they are. And they've contributed almost 50% of the gains of the stock market. So if you weren't in those 7 names, if you were in the 493 other names in the stock market, you did not see 30% returns. You probably saw closer to, still good, but 15, 20%, 15, 18% returns. So they were much more muted. And for the longest time during the year, they were in single digits, 3, 4, 5%. So most of the returns were felt by these names. So the question is, are we going to see a pullback from those 7 names and driving the market down, or are we going to see a broadening of the market exposure where everything else catches up?
So we just had the election too. So what does the future look like now with that?
Yeah, so there's no doubt that Trump on paper is pro-business, right? And in fact, just about every position or person he's put in at a cabinet head or at an agency head has had a disposition to reduce government size and reduce all the laws and maybe even get rid of the entire agency completely on itself. So the whole trend is towards reducing government. And from a conservative standpoint and a fiscal standpoint and economic theory 101, the fewer restrictions, the fewer rules and regulations you have, probably the more likely the industry will do better. And I'm going to try and keep this as apolitical as possible. What we have learned from, let's say, 2007, and even some of the most, fervor, the free market economists, some of the people that believe in the biggest amount of free market from 2007, like Greenspan, came to the conclusion that we do need guardrails in place. You can't just allow banks to leverage their portfolio as much as they want, because they will leverage it to a dangerous spot. So just as a reminder, in 2007, a regular commercial bank can usually leverage their money around 10 to 1. And the iBanks were allowed to leverage their money maybe 20 to 30 to 1, just by nature of the way that they were building their business. Because of the way they were packaging their bonds, they were increasing that leverage to sometimes 100 to 1. So then when the market turns, it's all great when it's moving up, but when the market turns against you, that 100 to 1 leverage is leveraged to the downside. So if you're predicting default rates of 1% and they go to 2, which doesn't sound like a lot, and it's really not a lot, if you're leveraged 100 to 1, that could literally kill all of your profits, because that 1% loss now is multiplied by 100. So you now have 100% loss. And heaven forbid it goes from 2 to 4. That's where we had the meltdown in 2007. So Greenspan was like, we need rules and regulations. So for now, Trump unwinding as much rules and regulations will probably be viewed as a great thing in the marketplace, at least for the free market economy. And I'm a free market economist, so let's be clear about this. I do want smaller government in general, but there is a limit. There is a reason why there are rules in place. You can't just allow just it to be free reign, unless, of course, you're okay with the entire banking system failing and allowing everything to go bankrupt and start over, which, of course, we're not okay with that. We need to have a stable banking system. So hence, there needs to be a balance between the rules and regulations and the free market. So to answer your question, I think we will still get a lot of economic activity. The problem is when Trump first took over, the multiples in the markets were much, much lower than they are now. So they were in a reasonable market space, right? You know, the long-term average of a PE ratio in the stock market is somewhere between 15 and 16. Right now, it's in the mid 20. We'll call it 20, 22. So lower to mid 20s. That's right around where we were when the dot-com boom ended. So we're at levels that we've only seen twice in the last 30, 40 years. So we saw it at COVID and the market traded off, and we saw it at the dot-com boom, and then we saw it in the bust where it unwound. So unlike when Trump took over before, where there was a lot of room for multiple expansion, there's just not that room today. So we should get some multiple expansion. We should get some additional market activity, but it won't be like what he had before. And in fact, I think in the years to come, we will see a market drawdown.
Is there a difference when a party takes control, either if it's the Democrats or the Republicans?
So the theory is because Republicans are in low government, low regulation, that they are more market friendly. What the numbers actually state, and I'm not even going to really speculate on this, but what the numbers actually state is the market has gone up much more under Democratic watch than in Republican watch. Now, why that is, we can speculate all day long. I don't know. It's gone up in both parties, but it's gone up much more in Democratic watch. The question is when all of the branches of government, the presidency, the House, and the Senate, they all go to one party or another, what that causes is some concern in the marketplace that a lot of rules are going to change. What the market really prefers is stability. I don't really care who's in the office. I don't really care who's controlling the House and the Senate. As long as there's a little bit of gridlock, I know what the rules are, and I can operate my business according to these rules. If the Democrats or the Republicans have all of the power, now these rules can be changed. Now the companies are like, I don't know what's coming. So if I don't know what's coming, I don't know what rules are going to be changed. I'm going to wait to see what's changed before I make any steps in my business. So traditionally, well, it's not just a transfer of power from Democrat to Republican or vice versa. It's more when one side or the other has all the power, then that creates instability, or at least perceived instability in the market. So generally, the market slows down, ironically.
How is the bond market this year?
So the bond market, as you know, we were at zero interest rates for a very, very long time. And then inflation started creeping in, and you had Powell say initially those famous words that inflation is transitory. And then what he saw was that it wasn't transitory, and inflation kept rising. And what he didn't want to do was have the inflation of the 70s and 80s that took 15 years to battle. So my opinion was, and historically, the Fed has never been able to successfully fight inflation with the 2-year Treasury rate being below inflation. So Powell kept trying to raise the 2-year Fed rate and the federal funds rate above the inflation rate, but inflation kept going up. So it was a battle for a very long time, and he kept saying it's going to be higher for longer and whatnot. So right now, those interest rates are slightly above inflation, but he is trying to thread a needle. So the only time we've seen a lot of interest rate cuts in the last 40 years is when we are heading into a recessionary period. Now, what has been suggested is we are going to have a soft landing, meaning we're going to cut just enough so that it's not going to help inflation, but also spur economic development. And so far, that's looked pretty great. The problem is, historically, we haven't been able to do that because any move the Fed makes today doesn't hit the economy for 9 to 12 months. And who knows what's going to happen 9 to 12 months from now? We don't know whether it's going to be overheated or whether it's going to be, whether the debts of some of the, like the excessive saving rates has worn off, and some of the credit card debts are higher than they've been in 10 years. We don't know if some of that debt is going to come to roost and then cause a slowdown in the economy. So I liken it to, let's say you're driving your car. You're fine. I'm driving the car. I have got a steering. I've got brakes. I've got the accelerator. I'm okay with driving the car. But what if I changed the car around so that anything you saw coming out of the windshield, wasn't happening for 9 seconds. So you're on a 9-second delay. And when you turn the steering wheel, nothing happened for a few seconds either. And if you hit the brake, nothing happens for a few seconds. How likely are you to crash the car? I mean, if you're just traveling down a straight road, probably could muster through it okay. But if there's any twists or turns, you're going to crash the car. And that's kind of how the Fed is operating with the economy. So if there's ever going to be a twist or turn that shows up, I think through no fault of the Fed, I think they're doing a great job. But the system is such that it's almost impossible not to crash the car to some extent. So you asked about interest rates. We're suggesting interest rates are going to fall slightly because the economy is slowing down slightly. What happened in the 70s and 80s is you had a run-up of interest rates, you had a pullback, and then it turned around and peaked at a higher spot than it was before. And then it came back down. And then a third leg went up even higher than it did before. And then it came back down. So then Volcker came in and said, enough is enough. We are going to really dampen down the economy, and we're going to fight interest rates, which he successfully did for the next 20 or 30 years. Powell is a student of Volcker, and he is really trying to not repeat Burns' mistake of allowing interest rates to go up. They have come back down. They have remained persistent, and unemployment's low. Energy's starting to get high. Housing market is limited in inventory. There's a lot of things in there. Trump talking about tariffs. There's a lot of things in there that are extremely inflationary. I don't care what Trump says. Tariffs are inflationary. Like, your prices will go up. That's just economic 101. You can't just add a cost and expect everything else to be the same. It's ridiculous to say that. So what Powell doesn't want to have happen is another leg up. And they're basically fighting that. And Trump will be locking heads with Powell saying you just need to drop interest rates. But if he does, it could overheat the economy and cause inflation. So right now they are slowly going down. He's dropped them by 25 basis points. He's looking to do it another 25 and trying to do a measured decline. But we're in a kind of precarious position right now. So time will tell, I guess.
So what about the alternative investments like gold, hedge funds, private equity? How did they do in 2024?
Yeah, so right now, as I mentioned, the stock market itself, defined by the S&P 500, are at historical high multiples. Because there's a fear baked in because of kind of Trump's rhetoric, gold has been doing great. Bitcoin has been doing great, both because Trump's political philosophy is somewhat Bitcoin friendly, and because there's more of a distrust of the government from some people. So there's some suggestion that Bitcoin will replace gold as the value store of currency, because gold is really a flight to safety, right? People are concerned if inflation's going up or if there's something going on with the government or the economy, I can hold on to gold and I'll be able to trade my gold for euros or for yen or for something. I'll be able to move it to some other area and it will be a store of value. And will Bitcoin do that as well? And it's possible. So right now, the market cap of Bitcoin is about 1/8 that of gold. So this is a little interesting statistic. I'm sure you know Bitcoin was over $100,000 recently. If it does take on the same market cap of gold, that might suggest it comes pretty close to being $1 million per Bitcoin. Like it's obviously a big number. So you asked about all alternatives though. So that's I think why gold and Bitcoin are doing well. Private equity has done well, and it's traditionally been an asset class that has outperformed the stock market. Right now, if you're in a private equity fund, like the stock market trades in a very narrow range over a 10-year window, maybe kind of 6 to 10% on average, pretty much consistently without much volatility over 10, 15-year window, where private equity will trade between 5 and 25% with an average expected return of being like almost twice that of the stock market, kind of in the 15, 18 range. Interestingly enough, private equity is trading at a multiple that is slightly under its historical average. So if I were looking for value in the market, and I am, and advising on my clients, would I want to go to the public markets that are trading near all-time high multiples? Or would I want to go to the private markets that are trading at or slightly below historical multiples? I think the answer is pretty clear for at least us. And then there's another driving force in that when I first got in this business 25 years ago, there were roughly around 10,000 publicly traded companies. Right now, it's closer to 3,500. So about 2/3 of the market have gone private. So if I just want the same options and level of exposure to companies that I had when I first entered this business, I have to go into the private markets because 2/3 of the markets have gone private. So if I'm just looking for that same diversification, same opportunities, same benefits, I need to be in that space too. And now, because of technology and advancements in the financial fields and whatnot, it's a lot easier to get into private equity. Unfortunately for the retail client, I was just at the Case Private Equity Summit in Beverly Hills just a couple months ago, and the data is that about 3% of people's portfolio is in private equity, and with the vast majority having 0%. Whereas if you look at endowment funds and institutional investment strategies, which is what I'm trying to bring to the retail market, let's just take Yale or Harvard. Their endowment fund routinely returns double digits, low 20% annualized returns. They have anywhere between 40 and 60% of their money into private equity and those venture capital and those kind of investments. Now, granted, they have a longer time horizon. They can wait through a lot longer economic cycles, but there's a clue there, right? Most retail clients don't have to have 100% of the money 100% liquid 100% of the time. And that's how they think. But if you're able to tie up 10%, still be able to liquidate 90% of your portfolio, but tie up 10 or 15% of your portfolio and put it into private equity and or hedge funds or venture capital, your return should benefit significantly. as will your risk will be lowered.
What about the hedge funds?
So hedge funds are kind of a catch-all. They, the definition basically of a hedge fund is whatever you want it to be, right? I could just decide to trade pork bellies one day and Bitcoin another day, and I could be in the stock market and I could short and long and do whatever I want. But the math basically says that 80% of all hedge funds go out of business every year. So that's a pretty tough environment to be in. So, and the successful ones that have been globally long-term successfully, they're all closed down to the public markets. You can't get access. So I would say they have their place, but I think it's a very difficult place for a retail investor to play.
What about the AI stuff? Especially when we talk about NVIDIA.
Yeah, so they've all gone gangbusters, right? NVIDIA's done great. It might be helpful. Can I share my screen and show you a chart of NVIDIA?
Yeah.
Is that okay?
Yeah, it's possible. Can you share? Yeah.
Yeah, so I'm just going to show you something. These are charts from YCharts. YCharts is a charting software that allows you to chart all sorts of data. Like you can see how price to sales and retail sales or economic indicators go over time. So here is a price to sales chart of NVIDIA. I'm going to put on price just so that you can see it. So NVIDIA price to sales is the purple, the price is the orange. So we all know it's gone through this huge meteoric rise of NVIDIA, right? Let me just take the price off. And I want to point out, long-term, this is a price to sales. So what is the price of NVIDIA divided by the top line revenue of NVIDIA? Long-term averages of most stocks are kind of around 2, roughly 2. So if I'm looking, I want you guys to look right up here. Here's the value. If I'm looking here, you see it's 1.3, 1.6, 2, 2.5. You're starting to get up into 5s and 6. You're coming back down here to 1, 1, 2, 1, 1. So long-term average right through here from, we're going to call this 2002 to 2015 of NVIDIA hovers around 2, 3, whatever. Pick a number. I don't care. It peaked at 45. It's trading at 30. So if my supposition is the relative long-term average of a company's price to sales is around 2, maybe it's 4, I don't know. Let's just say it's around 2. NVIDIA is at 30. That means it has to produce 15 times more than what it's producing right now just to be average. Okay, it's not even a software company. It's a manufacturing company making physical chips. Like it's a physical product that has to ship 15 times more. Now, maybe they can expand their dollar amount, get into higher level chips or whatever. It just seems like a really, really big number for me. There are other metrics where NVIDIA is not nearly as expensive, but this number seems to be like, let's just look at PE ratio.
Behind NVIDIA, who's behind them? Who would be second?
I mean, NVIDIA owns 90% of the market share. So whoever's second is not really much of a player. Like AMD is trying to get there. Intel's had a really rough time. You could argue that probably Apple has aspirations to be there. They're making their own chips. Just nobody has successfully been able to do it. So they're kind of the only game in town, to be honest with you. And it's just it's hard, but it's hard to get away from them. They're their biggest, one of the largest companies in the world, over $3 trillion, $3.5 trillion market cap. They are the center of the AI space. And so anybody who's creating AI needs to go through NVIDIA, which is why you're trading at these higher, really high multiples. You might want to play it slightly different in as opposed to NVIDIA is like, obviously NVIDIA can monetize the AI space, but who else can do that? Well, Apple can monetize it. Microsoft can monetize it. Other companies that have the ability and have the data can monetize it. That's why kind of Reddit has gone up, because it has a full-on data set of 20 years that doesn't normally cross over with all the other social media platforms. And it's all about having that data set. So those companies can monetize it. Other ways to play the space is it requires an incredible amount of storage. So like, esoterically, you're thinking all the stuff is in the cloud, but in the cloud means it's on the ground in a data center somewhere. So in the cloud just means it goes from your computer up to somewhere else, but there are physical locations that are built. And some of these, if you want to really get into the axe and shovels of AI, it's the chips, but it's also the data centers. So that might be a good place to play it, because everybody wants to get involved, and it's all going to require computing and data center space and energy, obviously.
So I'm gonna finish with that. I'm gonna finish with globally, like around the world, the geopolitic environment. How do you see that happening? What do you think is gonna happen, or what's gonna be the effects of certain things happening?
Well, I hope that most of what's happening is a lot of saber rattling and chest puffing. As you can see, like when Russia invaded Ukraine, our stock market really wasn't affected. And the statement around that is not that it's not a tragedy and that people aren't suffering and dying. They are. Syria and Assad regime just fell, obviously, in Syria. There's a lot of tension out there. The next question is it going to be Iran that's next in place? Is China going to try and take over Singapore? Like there's a lot of possibilities out there. Roughly, those areas don't affect our GDP very much at all. So, like if something were to happen in some of those areas, it would take a long time or a lot of interplay in order for it to really affect our economy. So for now, there's nothing that's in the horizon that seems like it would be horrible. I mean, unless China were to take over Singapore and we can't make any, AI chips, then that would be problematic. That'd be a big problem. So my guess is that there's going to be a lot of puffing out the chest and a lot of, some small strategic moves, but I don't think it's going to affect our economy and the markets that much.
What do you think? Which sector you think is going to be should we pay attention to in 2025?
Well, I think again we're data driven. So at these multiples, what the data says is there is no correlation towards short-term returns in the stock market and the multiples, which means they're independent. Like there's nothing to say that the market can't keep going up from here, and the market works on momentum. So probably will keep going up. So if I have to bet, and we do have to place strategic bets for our clients, momentum works. And so Trump being in office, he tends to be very business friendly. I think the momentum and the sectors that have been doing well will continue to do well for the short term. What I'm really concerned about is historically, you brought in interest rates. The interest rates have been, the 2 and 10 year have been inverted for almost 2 years. We haven't seen that level of inversion since the early 80s. Every time we've seen an inversion of the stock market has gone into a recession somewhere between 3 and 9 months later. We just got de-inverted. So what that would suggest, if history is any guide, and it has happened every single time, doesn't mean it's causational, but if history is a guide, in about 6 months, we could see a recession. And that recession could stem from the fact that a lot of the bills, the credit card bills, the auto payments, they've been put off. The buy now, pay later was up 45% year over year. We hit over $1 trillion in credit card debt, $1.3 trillion. All of those metrics are getting more exasperated. So if the consumer can't pay all those bills and their excessive savings rate gets worn off, that could cause a slowing of the economy, could cause a recession in about 6 months. Those things are aligning right now. So I don't know for sure that that's going to happen, but that's what I'd be cautious of. So to answer your question, I would keep just playing the same game we've been playing for the last year or two, should hold for the next 3 to 6 months, barring any weird event. But if there is a downturn, I would be fast to get out of those sectors and possibly just go to cash for the short term, because you're going to see a sell-off. What I bring in is those multiples, while they don't affect short-term rates of return, they highly affect long-term rates of return. And the long-term, 5 years or so, suggests that we will have a 0 net rate of return in the next 5 years. So a lot of ups and a lot of downs. So if you see the market and it tops out and it starts to feel a little not great, I would take some money off the table.
So you think tech is still going to be on top of all the sectors?
Probably for the next 3 to 6 months. You're going to have good momentum. It is the most expensive sector right now, but you will still see still everybody leans into that. It's not the only game in town, but it's the only game people are thinking about. And so I do believe it will continue to have its momentum. Traditionally, you see euphoria before you see a sell-off. And I don't feel like the market is euphoric right now. I don't feel like my Uber driver is giving me stock tips, or my person that I'm getting my haircut from, or whatever. When you get to that spot where people just are making money just because they're just out there, that's when I'd really be cautious. I don't see that yet.
Where can people learn more about you and follow you?
I am. So you can go to our website, which is kruseassetmanagement.com, Kruse assetmanagement.com. You can email me at Stuart@KruseAM as an assetmanagement.com, or find me on LinkedIn at KruseAM.
All right. Thanks, Stuart, for doing this with me once again.
Yeah, it's been a pleasure.
It's always, we did that last year, and this year you're here too. So I think it's been the 4th or 5th time you're on my podcast. So like I said before, you're my stock guy. So,
happy to be here.
Great. So I hope people found some value in it and they got educated. On that note, thank you everybody for taking the time to listen to the podcast, and we'll see you on the next episode. Bye.